Hello, everyone, and welcome. Trusts are valuable vehicles for the management and allocation of wealth. Used correctly, a trust can be a meaningful way to create wealth, as well as for the preservation of wealth. But the downside of a poorly structured and ineffectively administered trust can be equally destructive on wealth. For a trust to be valid and for it to serve its purpose, it needs to be governed according to its trust deed. Welcome to Talking Trusts. This is a frankly speaking conversation hosted by BDO South Africa. From sloppy to strategic trust administration, is your trust ready for the spotlight? I'm Ricardo Teixeira. I'm the Chief Operating Officer for BDO Wealth Advisors, and I'm your host for Talking Trusts. Thank you for joining the conversation. BDO has been providing professional audit, advisory, and tax services to families and businesses for over 60 years in South Africa. And to be candid, we've seen a lot of trustees and families struggle with optimizing the family trust for wealth creation. And I put it to you that trusts are wonderful vehicles and can be very beneficial if they are administered correctly. What we've seen in 2023 is that the reporting landscape for trusts in South Africa has shifted materially. The trustees' reporting obligations now to SARS and to the Master of the High Court are more onerous than what has been the practice of trusts and trustees to date. So with effect from April this year, we saw the mandatory obligation for trustees to submit records on beneficial ownership for trusts. We've also seen regulation that is now brought in anti-money laundering legislation impacting on trusts. And there's also the forthcoming SARS requirement for trusts to issue tax certificates, which has placed trusts squarely under the spotlight. So the days of sloppy trust administration are over. I think gone are the days of blurred lines between accounting and reporting and trustees' responsibilities for that governance of the trust. In today's conversation, what we're going to tackle, though, is these practical challenges, which tackle the practical challenges that you as trustees are facing in complying with the administrative landscape and legislative requirements for trusts in South Africa. I'm joined today by subject matter experts, all in the field of trusts and whose knowledge and experiences span across the law of trust governance, as well as trust tax compliance. Our intention for hosting this conversation is for you in your role as a trustee to be informed and to raise your awareness of how you can maintain a valid and compliant trust. And with that is so that the trust serves the purpose for which it was created. So before I introduce the panelists, just to let you know that the conversation is being recorded and will be posted to the BDO website as well as the BDO YouTube channel. And to get in, this will be together with all the previous episodes in Talking Trusts that we have hosted over the last 3 years. We have set aside time after today's conversation with the panelists for an interactive question and answer session. So I would encourage you to please engage with the topic. Share your questions in the chat, and we will facilitate a question and answer session at the end of today's conversation. So allow me to introduce the panelists. We have Carl Abrahams, Terina Jardem, and Danae Hull. Thank you. Carl Abrahams is an attorney and notary public and the in-house attorney at BDO Wealth Advisors. Carl is a member of the Fiduciary Institute of Southern Africa. And as attorneys go, Carl is passionate about exploring ever-changing world that he engages and consults to, and particularly around the opportunities that these changes present. He is a meticulous researcher, an analyst, and a strategic thinker, and takes very much a proactive approach in finding best solutions to challenges. Terina Jardem is a trust specialist at BDO South Africa. Terina specializes in the compliance of trust structures and advising and guiding trustees on the compliance requirements for trusts. Her role really entails the analysis of trustees' existing administrative behavior and is very effective at identifying areas for improving the validity of trusts. And Terina, too, is a member of Fiduciary Institute of South Africa, as well as the Financial Planning Institute of Southern Africa. And she's a qualified fiduciary practitioner of South Africa. So I think very well positioned to comment on the legislative environment for trusts in South Africa. And Danae Hull is BDO South Africa Tax Director, specializing in personal and trust taxation. Please don't be fooled by her youthful looks. She has more than 25 years experience. And I know that, Danae, you've often said to me in the passage that after 25 years, you look forward to the day when you'll have an uneventful tax filing season where there's no glitches and all the information is ready. So maybe this might be the change. Thank you, everyone, for joining our discussion. Let's get started. And Carl, if I can start with you. Excuse me. The landscape, Carl, for the administration of trusts has changed. I think it's the anti-money laundering focus on trusts that we saw come through late December to now is tangible. Carl, what has got us to this point, and why this grey listing?
Thanks, Ricardo. And yes, good morning to everyone attending this morning. So I think a lot of us on this call this morning drink, eat, and sleep the term grey listing. And I'm not going to bore you because I think we sort of have attended many seminar and talks around the grey listing. But some interesting facts, and I'll go to as to why South Africa was placed on the grey list. Obviously, grey list, the grey listing being regulated by the Financial Action Task Force, the FATF, 39 members. And it's a global body that sorts or seeks rather to combat money laundering and terrorist financing. So the reason for South Africa being placed on a grey list, I like to call it maybe a cautionary list, not a blacklist, but the reason being is because South Africa has not largely complied with certain requirements. Interesting fact, there are 39 members and not a single country has actually fully complied with the certain requirements or the certain international standard requirements that if the FAT have in place. However, certain countries are largely compliant, hence they are placed on the whitelist. South Africa, not, and we've been obviously placed on the grey list as a result of not largely being compliant. And the reason being, or rather the initiatives that we are facing as a country at the moment of non-compliance is because our programs and initiatives have not been up to international standards of combating these money laundering aspects. There are certain, we are placed on the grey list and being sort of tasked to rectify these irregularities at this moment.
And Carl, so I think that's clear. I think that we're not alone in this. We've seen it happen in other countries. But if you look at South Africa's scenario, what are the changes that have been introduced that have directly been caused by the grey listing as a result of FATF's findings?
So the obvious changes in terms of legislative changes, and rather the idea, and I'll get back to the legislative changes, but the change needing to be implemented, I reiterate, is to actually largely comply. And these are the practicalities. To
comply with money laundering legislation.
Yes, to comply with the international standards that FATF requires. And these are, the practicalities, which are your programs, your initiatives that South Africa needs to establish, which obviously we have. Hence come now the legislative changes, and largely there's been 5 acts that have been amended, which include the Companies Act, Financial Sector Regulations Act, Non-Profit Act, and the FIC Act, a big component of that. But obviously this morning, while we're here today, the change, or rather the amendments to the Trust Property Control Act, that has been amended by the legislature. These are the certain aspects, or rather the legislation that have been amended to change the aspect around the grey listing, the non-compliance of combating money laundering.
So very wide, I suppose, far-reaching changes to a number of legislative pieces of legislative pieces of regulations in our country. But Carl, just focusing on the Trust Property Control Act, what are we seeing there? What are those changes that are coming through?
Yeah, so there's been amendments to the Trust Property Control Act a lot now, purely based on the fact that South African trusts now are being scrutinized. And in this event, because of the amendment, can definitely be seen as an avenue for money laundering and terms financing. So the salient amendments to the Property Control Act, it's firstly the insertion of the definition of now accountable institutions. And that stems from the definition from the FIC Act, who is now, there's obviously accountable institutions have been prior listed. There have been a few amendments to that, including
FIC,
definition.
in terms of the acronym, FIC, Financial Intelligence Act.
Yes, yeah. And that obviously that definition of client onboarding, identification, verification has now been inserted in the Trust Property Control Act. There are certain other amendments, like a few more disqualification requirements from a trustee, just as envisaged in the Companies Act towards a director, similarities in there, consent from Master of the High Court in terms of foreign trustees administering trust property within the South African Act, within South African Trust, rather. Again, as I said, trustees are now to record certain details of certain accountable institutions that they work with, including service providers and the functions relating to trust property in that aspect. And I think the dreaded, but the main guy at the party is the beneficial ownership insertion of the Trust Property Control Act. And I know my colleague Tarina will speak on that, but those are sort of the salient amendments to the Trust Property Control Act to rather in line with certain international standards to combat our greylisting.
Carl, just reflecting on it, I think, if correct me, but the Trust Property Control Act was drafted in what, 1930s? And is that right? Possibly.
I think it's 1970s, 80s. Yeah.
Oh, is it? Okay. So
1988 to be exact. There we go.
and since then, there's been very little attention to the act.
Yes, there's a very short act as well. Yeah,
100%. Yeah, I think we should talk to your points now, and I think that's, if you just reflect on it, the focus of these changes is largely around South Africa's capability to demonstrate that we actually can meet global standards in financial action, and what Financial Action Task Force is driving across the world. Yeah.
100%.
Carl, what are the measures that regulatory bodies have brought into the governance of trusts? I mean, you mentioned beneficial ownership reporting as one.
So rather, yeah, so there's certain, and I won't delve into it quite extensively as my colleagues will delve into it later on, but there's some initiatives and implementations that our regulatory bodies have in place, such as RMCP programs that need to be sort of complied with, especially from accountable institutions.
Just RMCP, explain that.
Yes, risk management.
And compliance programs.
Compliance program, there we go.
That's it, yeah, correct. Yeah. Okay.
So
that's
your
just talking
RMC,
to the due diligence obligations.
So the due diligence on that is specifically speaking to those accountable institutions have to follow sort of this type of risk management compliance programs for their client onboarding and verifications. Again, the big one, and I won't delve into it so extensively as my colleagues will, but the beneficial ownership, there's actually a committee around it. So I call it the Beneficial Ownership Program, based on the implementation of submitting registers from a the Master of the High Court reporting aspect, but as well as a SARS reporting aspect. And then lastly, from trust now going to be third-party data providers. And I know my colleague Danae will talk about it. But these are some of the practicalities and the practical implementations, programs that have been implemented and effective since the amendments of the Trust Property Control Act has been in place. Yeah.
And Colin, I think what I like about your comment, and you're right, is the big attention, I suppose, is all around beneficial ownership reporting. However, I think what I take from your positioning now is the fact that there is a focus on risk management and the risk management in light of anti-money laundering.
Yes.
And I think we mustn't overlook the fact that trusts have now come squarely onto the Financial Intelligence Centre's radar. And so there's a number of implications around the accounts of institutional obligations, which impact. I think we need to
and you're absolutely right. Trust service providers, companies have come onto the radar for reporting standards or these RMCP programs, including, I don't think it was received quite well, but legal practitioners, attorneys are now considered accountable institutions to implement those RMCPs. Yeah.
Correct. And I think that is as onerous, although it's not getting as much airtime. I think it's as onerous as the beneficial ownership.
Exactly. And I think you've hit that on the head there in terms of it is quite onerous with these compliance programs now being considered a accountable institution.
Carl, just in closing out, when you talk around these changes, and particularly all the sort of reporting obligations that are being created through the change in legislation, there's obviously going to be a sanction for non-compliance.
Yes.
It's the carrot and the stick, no doubt, approach. What is that stick?
So obviously with all or majority legislation of non-compliance, there's a punitive sanction imposed on the non-compliance party. In this case, Trust Property Control Act, the punitive sanction is imposed on the trustees of any South African trust. And it's important not to just harp on beneficial ownership non-compliance, but the entire amendment of the Trust Property Control Act. And if those aspects or those provisions rather are not met by the trustees, a fine of 10 million rand or 5 years or even both can be imposed on the trustees of that trust. So I know we always harp on just the aspect of this new concept of beneficial ownership, but one must bear in mind that it's the non-compliance of the Trust Property Control Act, the Trust Property Control Amended Act, that is vital, that all provisions need to be complied with to not be hit with that fine. Okay,
thank you, Carl. Quite serious, but I think manageable if one manages it correctly in terms of reporting obligations. So thank you, Carl. Let's maybe then dovetail on that, or at that point, to Tarina, and if I can ask you, Tarina, to join the conversation. Welcome, Tarina. I think you've often said to me that trustees are solely accountable for their fiduciary administrative responsibilities in managing trusts, right? And I think you've also made it very clear in conversation I've had with you is that ignorance is no defense for a trustee when they are challenged by the Master of the High Court or by SARS or by creditors. And so, Tarina, if we just reflect now on this beneficial ownership reporting obligation to the Master, it's a material shift. Carl's given us a position on that. As a trust specialist and as a trust officer in practice, what are you seeing as the challenges that trustees are having in terms of interpreting the regulations, I guess, as well as the practical application of these reporting requirements? So quite a broad question, but really, what are you seeing in practice play out?
Thanks, Ricardo, and welcome to all the viewers. Thanks for joining us for this discussion today. There's been a number of practical challenges that not only trustees have experienced, but also trust service providers and other entities as a result of the introduction of these legislative amendments. And to just touch on a few, it includes, as you mentioned, the actual interpretation of the legislative regulations, but also in terms of the lack of records or trust records, that has always been an oversight by trustees that has now come to light with the introduction of these amendments. And then there's also been other practical challenges experienced by trust service providers and also accountants and tax practitioners. But what I think is important for us to acknowledge is that with any sort of introduction of new legislation, there will always be a difference in opinions and interpretations. And that's why this sort of platform is quite vital in order for us to have these discussions and establish clarity.
So, Tarina, maybe unpack two of or three of those challenges in interpretation. What are you seeing as the key priority?
Okay, so in terms of, I would say that the main focus or the main sort of difference in opinion relates to the beneficial owners that are required to be disclosed. We understand that while there is a general consensus in terms of the reporting on the founder and the trustees, but we understand that there are certain service providers that have taken the view to only report on the named beneficiaries. But we as BDO, we've really had, or we've taken a holistic view by not only acknowledging that subparagraph E does in fact deal with the named beneficiaries, but also considering subparagraph A of the definition, which refers to the persons that directly or indirectly control the trust property. So this would include ultimately vested beneficiaries within a vested trust that aren't necessarily named. However, we understand the context of a vested trust and what that means. And ultimately, those beneficiaries have a right to the property or to the trust property. The same as, for instance, a discretionary trust. In a discretionary trust, where the trustees have resolved to make a distribution to beneficiaries, that amount is distributable to those beneficiaries, and they therefore have a right to that sort of distribution. And that's why, as BDO, we've taken the view to not only disclose to the Master of the High Courts the named beneficiaries, but also those beneficiaries that are not necessarily named, but fall within a class of beneficiaries and have ultimately received distributions. I think that's another sort of consideration that should be made, is that if we look at the purpose of the introduction of these legislative regulations, it was ultimately introduced as a mechanism to combat money laundering. And with that being said, our regulatory bodies have an interest in the flow of funds that occurs within and out of trust structures. And that further elaborates the positioning that we have taken as BDO. I think that another point I'd also like to touch on is
Sorry, if I can just reflect on that. I mean, the point you make there is valid. So, well, I think it resonates, Tarina, is that if you listen to the context that Carl shared, is that the focus here is around anti-money laundering. And your interpretation on beneficial ownership reporting, what I'm hearing is that it's dovetailing, and it's saying actually look at the substance over the form.
100%.
So the interpretation, like you've said, of the form and the legal act may channel you into a different interpretation, but ultimately, in substance, it's about who's benefiting from the assets of the trust. Is that right?
That's correct. And Ricardo, we see that also being implemented from a SARS perspective. I won't speak in depth in terms of that because I know that Donné will cover that. But we've seen a notice issued by SARS whereby they've now referred to beneficial owners as persons that have had financial gain from trust structures. So that further supports the interest in who has benefited from the trust and not just the named beneficiaries.
Okay. Yeah, no, it's a very contentious issue, Tarina, and I think what you've highlighted there, that interpretation of it, is at the crux of a lot of the sort of challenges we see in practice with trustees. What else is top of mind for trustees in terms of practical challenges, Tarina?
So we also find that there's always been a duty on trustees to maintain trust records. However, over the years, there has been an oversight on the part of trustees. So the requirement in terms of the Trust Property Control Act is that trustees are required to maintain trust records for the life of the trust and an additional 5 years post deregistration. But as I mentioned, there has been oversight by the trustees, which has actually been brought to light with the introduction of these amendments. And what I find from my sort of experience with new clients that we take on is that they don't have information readily available with respect to the trusts. And if we consider the master's requirements, these are, for instance, one of the requirements is that they require the date in which the beneficial owner was appointed. For the purpose of establishing this date with respect to trustees, the previous letters of authorities that were issued are required. However, we see that the majority of trustees have not maintained this sort of documentation. In addition to this, we find that majority of trustees have not maintained personal data relating to the related parties of the trust, so the founder, trustees, beneficiaries. And where we find that trustees that have utilized an electronic system to maintain trust records have actually been at an advantage, in the sense that they have been able to comply with the requirements as soon as it became effective, because they had the information readily available. However, trustees that have never had some sort of reliable system of data storage or maintenance of trust documents have had to dig through archives to gather that sort of information, which is now a requirement.
So what I'm hearing there, Trina, is it's about document.
100%.
And I think you've made it very clear. And when you use the word records, I was going to ask you to explain it, but I think it's quite clear. It's broad. There's a lot of data that trusts manage, and it's that reporting which I think is creating a practical challenge for trustees. Is that correct?
Correct. And we see it with other regulatory bodies such as SARS now, who also require additional sort of reporting documents when submitting, for instance, tax returns.
Okay. Serena, what is the impact of these changes in reporting to the master and as well as the anti-money laundering provisions being on trust service providers?
So there are sort of practical challenges that the trust service providers are now experiencing. I would want to touch on the fact that they now have to register as accountable institutions, but I would say that is the easier part of the process, in the sense that actually maintaining that sort of title does come with a lot of responsibility and maintenance, and it can be an administrative burden for any sort of organization. If I can just cover a few of those requirements, it includes appointing a money laundering control officer, developing a risk compliance model that outlines how the organization intends to deal with the risks of money laundering. In terms of the onboarding of clients, an identification and verification process needs to be implemented. But in addition to that, we need to constantly screen those clients. And then obviously the responsibility to then report any suspicious activity to the FIC, the Financial Intelligence Center. And so we do see that it is quite an administrative burden placed on accountable institutions or trust service providers.
And who would be trust service providers? I mean, we talk about this responsibility. I don't really cite it, but it is onerous. When you talk about trust service provider, that would be an accountant, tax practitioner, trustee. Who who be registered as an
So
accountable
the way
institution?
that it's defined, and I think that this is also another sort of topic for discussion, in the sense that there are various views as well, but it basically covers any sort of organization that has been involved in the creation of a trust structure, in the operation of the trust structure, and the management of the trust structure. So we do find that some accountants or tax practitioners are of the view that they are not necessarily involved in the operation of the trust structure. However, to summarize, and my point of view is that they would be, because ultimately they are performing a function on behalf of the trustees.
Okay, all right, yeah, and I think I'm glad you elaborate on that, because you've made it clear that there's beneficial ownership reporting. It's a clarification of who is a beneficial owner, but it's also the accountable institution obligations to the FIC, which is, again, another material change for trusts and the trust service providers.
Yeah, Ricardo, and I'm sorry if I can just also elaborate in terms of accountable institutions. On the part of trustees, there's that responsibility that trustees need to maintain a record of all the accountable institutions that they deal with. So we do see that, and as Kyle rightfully mentioned, it's important that everyone considers the fact that the sanction is not only applicable to non-compliance of the beneficial ownership register, but it's also for non-compliance of maintaining a record of accountable institutions.
Right. Okay. And I think the point you make is actually quite valid, Trina, because there's no obligation to report that register to the master of who the trust is engaged with as an accountable institution. But you've got to maintain it, and on inquiry,
provide it. Yeah,
sure, that's very impactful. Yeah, and I see, Trina, thanks. We ran a couple of polls, and I see there was some. Thank you for participating in it. And the one question you asked, Trina, was, would a digital system of recording and storing documents be beneficial or not? I think there was quite a favorable response to that, and which I think talks to your point of being able to have access to data and records. I think that was 99% voted in favor of electronic documentation. And interesting enough, also the question you asked is, will you be submitting beneficial ownership reporting? And there was 13% of the attendees today who have said no, they would not be submitting to the Master of the High Court with it. So is that the kind of, and so 87% are saying yes, 13% say no. Are you seeing that as the stat coming out? And what would your advice be to those who are voting no?
So Ricardo, there has been some sort of reluctance by, I'd say, minority of trustees in terms of the submission of the beneficial ownership reports. And in my discussion with those trustees, the main concern seems to be the security of the Google Form platform. We understand that the submission needs to be made via the Masters portal through a Google Form platform. However, in my consultation with experts in the digital space, they have provided reassurance that Google Forms is a secure platform for the submission of personal data. I do believe, and this is my personal opinion, I do believe that the sort of uncertainty actually stems from the distrust with respect to the Master of the High Court, and rightfully so, considering the fact that it has been an administrative burden dealing with the Master of the High Court for a number of years.
Okay, and when you say the distrust, is it distrust in terms of the capability to process data, or is it in terms of what that data will be used for? What are you finding in practice as the distrust?
I think there's concern in terms of both. So we understand that there's information that's constantly lost at the Master of the High Court. There's a delay in the processing of information. And so because there's a disclosure of personal data relating to, the founder, trustees, as well as beneficiaries, there's a concern that that data will get to the wrong hands. And we have had concerns in terms of kidnapping risks and so on and so forth, because we are dealing with high profile clients.
Okay, so the concern there is about, is my data secure and how's it going to be used? And you mentioned the word kidnapping, and I think that just prompts a whole lot of thought around actually, well, is my data going to be breached, and is my physical family security going to be attacked? How do you deal with that? Because I mean, that's a real concern, but yet you've got this obligation, and you've got the stick that I said to Carl, that you've got to submit information, otherwise there's a sanction, a punitive sanction, administrative sanction. As a trust specialist, what do you advise trustees to do in that instance about personal data?
So in terms of this requirement, it is in effect. And my advice to clients is that whether they choose to make the submission or not, ultimately, because the legislation is in effect, they will be held liable for non-compliance if they choose to not make the submission. The other consideration to make is that with any sort of introduction of new legislation, there will be that time period in between when the legislation comes into in effect, and then where one party or the first party is sanctioned. Within that period, there's a lot of reluctance, and we saw it with the Poppy Act. The Poppy Act became effective, and then 2 years later,
Poppy stands for
the Protection of Personal Information Act.
Right.
Absolutely. So we saw that only 2 years later was an organization sanctioned for non-compliance. And then, everyone then rushes to be compliant. So it's really up to trustees to determine if they want to run the risk of not sort of submitting it, because there is sort of also a question of how serious is the Master of the High Court about these sort of regulations. But you need to ask yourself the question, are you willing to be that first sort of trust that is going to be sanctioned and made an example of?
Okay, and all in the interest of removing South Africa from the greylisting.
100%.
Through an anti-money initiative, and getting your trust caught up in one of these inquiries. Trina, I think you make a very good point. And I think what I take from your reflections today is that it's pretty much take action. Either do it yourself or get someone to help you, but don't sit on the fence. Make a decision of where you sit with these obligations of beneficial ownership reporting, as well as the accountable institutional register.
That's correct, Ricardo.
Yeah, thank you, Tarina, for your reflection.
Thank you so much, Ricardo. Thank you.
If I can introduce Danae, and you can come on. Thank you, Danae. I think if we look at the beneficial ownership reporting to the master, that has materially shifted the needle for trust administration in South Africa. From a tax compliance perspective, Danae, and bringing SARS into that, what is the link to this reporting requirements for trustees?
Thank you, Ricardo. I think SARS is thrilled by the fact that there's now a new compliance champion, and that being the task force. And with respect to SARS, I think this task force really has bigger teeth, and the bite is going to be severe. Tarina and Kyle spoke of the punitive measures, and a 10 million and prison sentence seems to be scarier than what SARS has over the last number of years, perhaps tried to threaten trustees with. But I think one needs to just understand SARS's viewpoint. And Tarina mentioned the distrust with the Master's Office, but I think SARS has a great distrust of trust structures and trustees. And rightly or wrongly so, I think us in the tax profession know that SARS has a long history of distrust. And I think, having heard the statistics recently, that hundreds of thousands of trust tax returns over multiple years remain outstanding, one can really understand SARS's wariness when it comes to trustees fulfilling their fiduciary duty in reporting. And from a SARS perspective, the concern with these long outstanding trust returns is largely the mismatch between beneficiaries receiving awards, so awards of a capital or income nature, disclosing that on their personal returns, and then there's no financial statements or tax returns submitted by trusts to sort of reconcile and compare to. So I suppose SARS has really tried their best to try and get trustees to be compliant with the taxes. Now, renewed energy and renewed focus, because with the Financial Action Task Force really wielding the stick with these punitive measures and coming in from a different perspective, SARS is really jumping on the bandwagon of compliance, because to my personal and professional view, beneficial ownership has nothing to do with tax. It's a definition that's now brought in by the Trust Property Control Act. SARS doesn't manage Trust Property Control Act. That's a master and the trustee's obligation. So it's this foreign concept that all of a sudden finds its way, not into tax legislation, but into tax practice. And that will be the tax return. So in my view, the reporting to the master should be it. But SARS has now found reason, and whatever it is perhaps they are the mirror to then and control, perhaps they are the control, let me rather say, to ensure that whatever information is reported to the master has a mirror effect on the tax return.
Right. And Renee, I think that's a very powerful reflection. And if I can just loop it back to Kyle's opening remarks, is that the changes we've seen and the spotlight on trust is driven by anti-money laundering provisions. And what you've quite eloquently positioned is that there's this gap in terms of disclosure of beneficiary distributions versus tax compliance. And the two are not very far apart. I mean, they're actually they're very relatable. And so you can see that theme coming through now, okay, in terms of the changes. So thank you for explaining that. And I think that makes it very clear as to where the link is. Today, what are the new changes? And I'm asking that, I think we just ran a poll, and of the audience, 33% are not aware of the new changes that SARS have introduced in terms of tax compliance. Please maybe unpack for us, what are these changes that are being made effective now?
Sure. And I think there's different stages of changes, and already last year we saw SARS trying to focus on a concept of registered representative, also foreign to tax, but ultimately what they wanted with regards to trust tax compliance is that they wanted one trustee to put their hand up to say, we will act really as the contact person with SARS. So no trustee takes away from the other trustees the obligation and on the fiduciary duty, but I think SARS wanted one main contact person. And one thinks it's a simple process of appointing this registered representative on SARS's system, but again, it's admin and documentation. So we saw that come about a year or two ago with before one can complete a tax return, you have to answer on the wizard that you have updated the trust representative taxpayer as well as banking details. So the administrative burden on trustees is just, layer upon layer. But nevertheless, that is a process that should have been done. And maybe to the topic of discussion, we've been getting away for many years on the administration of trusts, whether from a trust administration perspective, a compliance perspective, as well as SARS. It's now catching up on everyone. So those changes were obviously over the last couple of years that SARS has tried to implement those. But with the changes in and the various changes to Trust Property Control Act, this whole beneficial ownership, we have now seen that the 2023 tax return specifically mentions beneficial ownership. Again, to my point, I don't think there's a need to duplicate the work, but once you've actually reported it to the master's office. But before you can complete your 2023 tax return, the page that details beneficial ownership needs to be completed. And and again,
you actually cannot submit the return until you've completed those details on the e-filing page you're talking about.
Yes, correct. So on the actual tax return, so before a trustee can sign off, make a formal declaration that the return is full and complete, as tax practitioners want to refer to, that beneficial ownership has to be done. And that's why BDO has always, from the beginning, in all of our communication together from a tax perspective, as well as Ricardo from a wealth perspective, I know we've been really trying to insert our view that the Master's Office reporting is key. The Master's Office reporting by a BDO Wealth and a BDO Trust Administration team needs to be done first. The trust reporting on the tax return is then just a mere mirror reflection of what it has already been reported. And I think that's where SARS is saying that they just want to reconcile that and match it up to the Master's reporting. But with the actual tax return, as Tarina mentioned, SARS is now recently, in September, we've even had recent changes as on, I think it was Monday, that were made and guides released, is that the supporting documents that SARS now requires to it also speaks of organograms, these schedules, the trust documents, minutes to trustee meetings. And again, I ask the question, why is it a tax problem when I truly believe it should largely be driven by the Master's Office? But nevertheless, and just one more point to the 2023 filing season, Ricardo, is that SARS has, in an attempt to, as they always say, simplify the process, is that they've suggested or created a simpler tax return. And they make reference to a simpler tax return is for a trust that is a passive trust. Now, I don't really know what a passive trust is because as a tax practitioner, I always go to the Tax Act, and there isn't a term as a passive trust. And a passive or passive income, to my knowledge, is any return on investment as interest, dividends, etc. But SARS's view of a passive trust is now our old dormant trust, where there's no transactions, where there's hardly any assets, there's no return on income. So a trust that's been registered, but in actual fact, there's no transactions for assets, but it has an obligation to submit a tax return. Correct. And I think fundamentally, that's a very good point. That's a starting point for all trustees, is to remember, irrespective of what assets or financial value a trust has, as soon as you have a trust, you have an obligation to register with SARS, as well as to submit annual tax returns. There's no such thing as, oh, the trust is dormant, so it's not required. There is an obligation. And that is why perhaps there's those hundreds of thousands of returns that SARS claims to be outstanding. Yeah, I think absolutely, Donna. And I think just reflecting on that, I think that's the crux. What you've described now, this non-tax compliant number of trusts, just didn't happen by chance. It happened because trusts haven't been administered. And it's the perception of trusts in the past has been very, very sloppy, to be frank, is that actually trust will only be administered when there's a need. So when there's a transaction, it gets done. And I think what we see now, the theme coming through consistently, is that it's been buttoned up from all stakeholders' perspectives around
trusts are very important vehicles. Keep your house in order.
Correct. And I think that's why SARS jumped on the bandwagon when the greylisting happened, to try and get all of that up to date. Ricardo, we actually don't know what's in those hundreds of thousands of tax returns. I think the commissioner, rubbing his hands together, thinks there's undeclared income. So who knows? And one will only find out once trustees get compliant and are up to date.
Janae, you've reminded me, I think it was in 2021 that we hosted yourself with Fia van der Spey on Talking Trusts. And I think yourself and Fia put a number to that gap. Do you remember what that number was of the tax gap back in 2015?
A lot, I think.
It was 50 billion, if I'm not mistaken. Okay. So there was a tax gap. I remember, Janae, you and Fia had this conversation. It was about between distributions made on trust tax returns in 2015 versus beneficiaries' disclosure of distributions received, 50 billion rand. So I think you're quite right. SARS are rubbing their hands.
Yeah. But I think, Ricardo, just very importantly is while we're talking about the 2023 tax return, just to remind our trustees, we've got a filing season coming up for non-provisional taxpayers. Now, in the good old days, and the good old days is when I still completed returns with a pen, was that a trust was registered as a provisional taxpayer, irrespective of income, whether there was taxable income or not. That's gone. So the non-provisional 2023 filing season deadline of the 23rd of October is also applicable to trusts, where trusts do not have any taxable income left in the trust to be taxed. So take the scenario where a trust has income. We make the award to the beneficiaries, as the majority of our clients do. The trust has no taxable income left, and therefore by default is a non-provisional taxpayer. So and
that's a change for 2023.
No, actually not. It's been in law for a long time, and I think we only started to feel SARS's pinch with enforcement recently, maybe over the last year or so. But yeah, it's been in the law, and I think that also adds to the sloppiness, is that the law is there, and the law is there to it's just not policed and monitored. So the law, I mean, by the Income Tax Act, dictates that SARS has punitive powers as well to enforce compliance. It just hasn't, thankfully, been the stick hasn't been there. So that is tax return, but most importantly, Ricardo, of all of the changes is then the need.
Is there more?
Yes, sorry.
No, I think I just
But I think, yeah, this is a crucial one. SARS has made trustees I don't want to say in a reportable institution, because that's also a different term, defined term, but trustees are now required to render third-party information to SARS. So think of a bank, think of a medical aid or a pension fund, a retirement fund rather. They are third-party data provider. Employers, as simple as that. An employer is a third-party data provider to SARS. Meaning you have to report to SARS on certain information in the form of a tax certificate. Employers issue RP5 certificates, banks issue certificates reflecting interest and dividends, etc. Medical aids reflect your contributions. Now trusts are required to report on what awards, the quantum, the nature of awards made to beneficiaries. Trustees are also obliged to report on financial information. So what that now means is that by the end, for the 2024 tax year, meaning end of February 2024, that is your first year of reporting. So trustees have until the end of May 2024 in order to issue these certificates to SARS, in order for SARS then to pre-populate the 2024 tax returns for beneficiaries. It's exactly the same mechanism that an employer and an ROP5 follows. So that is I think
that's
the
significant.
surprise.
Yeah. That is significant. Yeah.
Yes.
I mean, just if I play back to you that the significance of that change of an obligation for trustees to report to the data to SARS means that if the deadline is not met, would you say May 2024, it then implies that actually whatever's not been distributed, the trust is liable for tax. So the conduit principle falls away.
Yeah, but what it does do, Ricardo, and myself as a tax practitioner am thankful for it, because it actually puts a bit of fire under a few trustees, because
100%.
remember, by February, the trustees actually have to pass resolutions. So before the end of the financial or the tax year, I should rather say, the end of the year assessment being February for trusts, largely, trustees need to know what is the financial position of the trust in order to pass resolutions stating what awards need to be made to beneficiaries, if any. Of course, if beneficiaries if awards aren't made, then the trust needs to suffer that tax. So what it means is that by the end of February, you've got to have a very good idea of what the trust's financial position is in order to meet the resolution obligation, and then in order to, by May, have the necessary documentation in hand to issue those IT3Ts, that is the tax certificate's formal name, in order to render to SARS. So you can't make a guesstimate when you do that IT3T. That is a certificate. That is a declaration. So Ricardo, you and I have had good discussion amongst each other and with our business services side, BSO, business service outsourcing, that's the full name, is that, you know, the accountants, the auditors, the trustees need to empower our accountants and bookkeepers in order for them to have monthly accounts, so that it's a running total, in order to, by end of February, have a 99% idea of what's going on in the trust's accounts, so that they can make the necessary decisions by end of February, and then March and April have the reconciliation, just making sure, dot the I's and cross the T's, in order to then to make the full declaration on the tax certificate by May. Yeah, exciting times.
Janae, I don't know if everyone would use the word exciting, but daunting, but yet I think it's just bringing it back, and I think just closing now, and I think the comments you've made around tax compliance, I think really dovetail well with the suggestion that Shireen's made around administration. Have the documents. So your comment now is that there is no ways a tax practitioner is going to help a trustee meet the tax compliance without data. And there's no ways that that data will be done unless you've actually been active during the course of the year. And it's done real time, as opposed to we'll get to it when we get to it.
Yeah, exactly.
Thank you, Janae. Yeah, and I think you asked a question, is your tax advisor a registered tax practitioner? I think there's a majority, 84% have said yes, 11% have said not sure. But I think the point that I take from today's conversation with you, it again highlights the need for professional help, not only in the tax administration, sorry, the trust administration, but also the tax compliance. Is don't do it alone. The complexity is really huge.
And just a point to add to that, I saw a lot of our viewers mentioned they're going to rush off and terminate the trust because of the compliance obligations. I do believe, as a tax professional, that a trust has a place still.
Correct.
Irrespective of the volumes of additional administrative burden that it seems to be placed on trustees now, I just think the reality is that it is time to meet the obligations that have always been there. But a trust has a place for wealth planning. A trust has a place for estate planning, looking after minors, and legacy for businesses, and the legacy of high net worth individuals. So definitely, one must never discard, one must never necessarily change your hat as to why you created a trust in the first place. Those reasons stay and stay valid. It's just a question of now being able to, I suppose, catch up on your compliance and maintain it. And really the thread throughout our whole discussion, from what I found from Tarina and Kyle, is that, you know, gone were the days that the head of the family and the family trusts must be maintained and looked after by the family members, you know, the patriarch or the matriarch of the family.
Yeah.
But give it
That's
to
right.
a professional trust administrator or professional trust company, in order that you not only need to not worry about the admin gremlins and the administrative burden, but that you know that you're compliant in every regard, because it's just becoming more and more cumbersome. But the reason why we created trusts is still a valid reason.
Jeanette, thank you for closing on that. And I think we're going to move into the question and answer session. So I'll invite Carl and Tarina back online. But I think the point you emphasize, and it reminds me of a conversation we had in 2022 on Talking Trust, when we spoke around the purpose of a trust. And I think it's that is a starting point, is if you are clear about the purpose of a trust, you will then know how to administer it, and it will give it life. The concept of deregistering a trust is right if you don't have a purpose for it. So go back to that. Yeah. Thank you, Carl, Tarina, and Jeanette. It's been insightful. Thank you for coming back. And I'd like to welcome Rashika Hiralal to our panel. Rashika is a trust specialist with BDO Wealth Advisors and has been, I see, feverishly answering lots of questions on the chat, Rashika. So thank you.
Hi, everyone.
Welcome, Rashika. So I'd like to, I think we've got a couple of minutes and we'll aim to close possibly just after 12:15. Rashika, are there any questions that have you posted that we can look at the panel? Oh, there we go. All right. So there's a question from Andrea. If the trust is an employee incentive trust, who would the beneficial owner be? If the trust had to be wound up, any shares held by the trust would revert to the company. So it's difficult to understand who the beneficial owner would be. Tarina, would you like to answer that question for Andrea?
Of course, Ricardo. So from a BDO perspective, as I touched on earlier, we would consider the named beneficiaries to be disclosed for the purpose of the reports, but also any beneficiary that has received a distribution. So they would have to consider ultimately if any sort of employee has received a benefit from the trust. And then in the instance where the trust is, I think the viewer made mention to the fact that the termination clause refers to the fact that ultimately at the time of termination, the distribution, it goes back to the company. The company will then be a beneficiary, and the beneficial ownership report needs to be updated accordingly, with the company being the beneficiary, and then obviously disclosing the representative of that particular company, because a distribution was made to that person and there was financial gain.
Okay, thanks. So I think, Tarina, you make a good point. So it's following the money. And so, you know, incentive, employee share incentive trust, you may not have named beneficiaries, but it's if there's been distribution and benefit received, follow the money and report. Okay.
100%.
Thank you. That's good. Carl, there was a question here that's quite broad, but I think I'm going to put it to you. Is what happens now with all these changes holistically? Where does it place us in terms of the legislative landscape?
Thanks, Ricardo. I think just looking at some of the comments on the chats there, I think sort of our attendees are asking what now? You know, from a SARS aspect, from a master's aspect, and one really needs to be cognizant of the fact that we are in unprecedented times at the moment. That the amendments that have came about were quite abrupt. There's no real time period as to where, as trustees, need to comply with. So what are we seeing at the moment? You know, from a master side of, you know, dormant trusts, and as Danae said, sort of trustees are wanting to go and deregister and so forth. Our regulator bodies, SARS, the master, may not be calling for it at the moment. From a SARS directive aspect, yes, it's, and I use the word loosely, mandatory, because one cannot submit tax returns without that beneficial ownership register. On the other aspect is that, example, a deregistering of a trust. Yes, we've here at BDO, we have experienced this where we've submitted these documents and the master hasn't called for it. However, our approach should not be stagnant. It should be holistic, and making sort of the trustees aware that these are the regulations and rules. Sanctions will be imposed in this. We unfortunately are in blurry lines at the moment with master. I know us as FISA members, I think for the first time, the Master of the High Court will be addressing us with these changes at our annual conference next month. So there may be sort of a clarity on that, but at the moment, trustees need to be aware of these rules and regulations that carry a hefty sanction on them should they not.
I think it strikes home that the materiality of these changes is such that actually there is going to be a lot of engagement. And I don't think the Master of the High Court is taking it lightly, nor SARS.
Yes, and it's onerous.
Unprecedented times.
It's completely onerous as well.
Absolutely.
And yes, yeah. So
see, Yvonne de Beer just made a comment that she's been, Yvonne de Beer just made a comment, she's been scared to death. And that is not the purpose for today. The purpose is to raise awareness. And I think so. It's, if we are aware, it's actually how do we deal with it?
Exactly.
So I thank you, Carl, for clarifying that. Rashika, I'd like you to, I think, address this question. It's dealt with from Anonymous and said, would this requirement for beneficial ownership reporting apply to charitable trusts who distribute to various charities from time to time? I think a very good practical question. Would you like to share your practical experience on that?
I actually administer quite a few charitable trusts. So I think it's important to note that a charitable trust is actually seen as very high risk vehicle for money laundering and terrorist funding. So my suggestion would actually be is to do the beneficial ownership report for charitable trusts on a yearly basis once the financial statements are completed. There is a column on the beneficial ownership report as to, you can put the date as to when the organization became a beneficial owner and when it ceased to become a beneficial owner. So if it is an annual beneficiary that changes from year to year, that part is actually important to fill in. And yes, definitely charitable trust has to declare their beneficiaries, and the beneficiaries that receive a benefit from charitable trust are seen as beneficial owners.
Whether they're named or in a class of beneficiaries,
yes.
I think if I'm following your conversation and with Trina's, is that they've received a benefit recorded.
Yes, I think many people are looking at the class of beneficiaries as a loophole not to declare those beneficiaries, but with the SARS regulation coming into play, that takes that loophole away.
And Danae, I'd imagine that would apply to SARS as well. SARS, IT12s is that you would have to declare charities that receive distribution.
We're hoping that eventually SARS will see the light and say no for PBOs, because we've got many public benefit organizations that make awards to many institutions, not just to a handful of select. But, you know, think of you know, just off the top of my head, and we've got 5 or 6 different public benefit organizations, and depending on the donations they receive, they make tens of millions of rands worth of awards to certain institutions that make application. So they aren't known beneficiaries, to Rashika's point, or named beneficiaries, but they qualify in terms of the public benefit organization's mandate, that they can look for donations and or awards. Now imagine having to issue tax certificates for those tens of hundreds of institutions. It becomes a bit of an admin nightmare then for the trustees and the PBO
there's
trustees.
No tax gap. And so, like you were saying, exactly, is this practical?
Yes, correct. Correct.
Renee, while you have the mic, a question that came through is, do all beneficiaries require tax numbers?
I want to say no, but practically, you know, when you don't, let's start from the very beginning. The Income Tax Act defines when you must register for tax purposes, and that's essentially when you have taxable income. So if a beneficiary receives an award that becomes liable for tax, then of course, tax number. But if you start looking at the forms that you fill out for trusts and even potentially now on these tax certificates, there's a segment that then requests tax reference numbers. So I think once only we start playing, and when I say playing, exploring the declaration routes of the IT3Ts, and it becomes compulsory, then you've got a problem, because then you're going against law just for disclosure purposes. So I still believe you have to follow the principle of the law, and if you qualify that's your awards qualify you to be liable for income tax, you have to register. But it would be interesting to see if the tax certificates, IT3Ts, compel you to, in any case, register. And I think it's all about reporting and following, SARS being able to follow the money.
Got it, yeah, okay. Serena, can you reflect on, I think the comment was made around the effective date for beneficial ownership reporting, but is there a due date for submission of beneficial ownership reporting?
No, Ricardo, so there isn't a due date for the submission. It is currently in effect, so any trust that has not complied with the reporting obligation is considered to be non-compliant. However, one should also consider, as Renee mentioned, that, for instance, with non-provisional taxpayers, tax returns need to be submitted towards the end of October. And in that submission, a supporting sort of document is a report on the beneficial owners. As Danae mentioned, we wouldn't want to sort of double the work. And, you know, we're quite fortunate at BDO to have professionals in the tax space, trust governance space, as well as in terms of the preparation of financial statements. So in terms of our sort of structure, it would make sense for all of our clients to have those ready, or to have those beneficial ownership registers ready for that tax submission.
And align it with that deadline.
Yes.
Okay, now that's good advice. Thank you, Trina, for clarifying. Rashika, and maybe perhaps Danae, if you want to comment, start with you, Rashika. There's a comment around passive trusts and dormant trusts. Do we need to prepare financial statements for a dormant trust? Rashika?
Well, I think you have to look at the definition of dormant. Many people think that their trusts are actually dormant, but there's no such thing as a dormant trust. So first of all, there should be that initial donation that would have went into that trust, which should actually remain in the trust. So that needs to be reported on, and that will be carried forward in the financial statements on a yearly basis. And some people also look at a trust being dormant if there's a property in that trust and nothing else. But that property is an asset of the trust, and that needs to be reported on. So that is actually a financial statement item. So I think that people do actually need to look at the definition of dormancy of a trust. I don't know, Today, if you want to add to that.
Yeah, no, 100%. Now we've got the word passive also thrown in, but I think fundamentally, and the Trust Property Control Act, I don't think prescribes in what format trustees have to report the financial information. Trust document obviously says whether this information needs to be audited or not and things like that. But I think just for the majority of trust clients, I would recommend having at least a statement. Gone are the day of writing something on the back of a matchbox. It's just not going to fly anymore with compliance. And if you just have, whether you have an Excel spreadsheet or I know our clients really readily rely on our business services to prepare financial statements. They don't need to be audited, but just a nice compilation. It just gives, I think, clarity, if I could use a word, to your financial position, that someone has looked at it, that someone has vetted the information, and that it's clear and transparent. So I highly recommend that the reporting and financial position be stated better than on the back of a matchbox. But to the point of dormant trusts and stuff, there is no such thing as a dormant trust. Prashika, you're 100% right. And the tax return compliance obligation, irrespective of whether there's just the donation that should be lying in a bank account of the trust, and not just
that alone creates the fact that that alone creates the fact that trust is not dormant. Every trust should have a bank account.
Correct.
Yeah.
Fundamentally.
So Rashika, I think you're quite right. We need to revisit that terminology of dormancy. Yeah. And I think yes, Tarina.
Ricardo, I just wanted to also add on to that. It's important that we consider the Trust Property Control Act's provisions, which doesn't necessarily, as Donnay mentioned, make reference to financial statements. However, any trust that has been registered is required to maintain an asset register, whatever that format looks like. We do find that trustees prefer to have a set of financial statements. It's just an easier read. But also, we find that a lot of trust deeds make mention of the fact that trustees need to maintain books of account. So we need to basically, every trust will be different. So with some trusts, it is sufficient to just maintain an asset register. However, others will provide further clarity in terms of maintaining books of account as per the trust deed provisions. And as I say, it relates to every trust that is currently registered, regardless of the sort of activity within the trust. They would have to comply with those provisions.
Okay. Thank you for clarifying that, Trina. I think you make a good point around asset register, often overlooked, and the deed, understanding it. Yeah. And I'm going to close out on that deed, Carl, with you a question, which has been put through now by Waleed. David's, do trusts need to be audited?
So the Trust Property Control Act doesn't require for it. It does obviously say maintenance of or record keeping of financials, but no. So trusts do not have to be audited. Even when you establish a trust, there's a little question on the master's form there that there's no requirement of it. However, it is obviously advised that proper record keeping, proper financial record keeping of a trust is maintained.
Okay. And I'm assuming then, again, that record keeping obligations of the trust would fall on the deed every deed would be different. So the
Every
requirement for
deed would
audit
be different. 100%.
may well
Not to
be
say that
encapsulated.
exactly.
Yeah.
Not to say that there won't, it can't be audited, obviously, but every deed is different. And if the trustees do want it, then it may very much be inserted in that deed. But yes, key point, maintenance of
that
record
is what I was actually going to add, that certain trust deeds, there is a provision that calls for an audit. And if the clause on the trust deed actually states that the trust needs to be audited, then that actually has to be complied with.
100%. And that's obviously the founders of the trust's intention, but legislatively, it's not bound. A deed is the contract, and whatever the trustees and founder agree to, they have to comply with that contract, the deed itself.
Excellent. I think we've reached the end of our time. I want to thank my specialists, subject matter experts on the line, Danae, Tarina, Rashika, and Carl. I've really enjoyed the conversation. I think you've had a lot of value. There are a number of questions we still haven't answered on today's call. We will do our best to reply directly to the questions that have been submitted. So thank you for your participation. I think just in closing, it's fair to say that if you're a trustee or beneficiary of the trust, your goal has to be to recognize and realize that the benefits of this trust that's been established for you can only be maintained if you actually are proactive in administering it. And I think it's fair what I'm hearing from today, and in practice what we've seen is that a trust runs a risk of being invalid or not compliant and not serving its purpose if it's not administered. And so the call to action really is it's time to act, and I think take action in terms of your own trust deed, understand what the deed requires, and take steps to actually maintain the validity of the trust. Put in place systems for administration, govern the trust according to its deed, and comply with all the legislation. It may sound onerous, but you don't have to do this alone. If you're looking for help, reach out to professionals. The BDO offers a suite of services to help trustees. We also collaborate with other professional trust service providers. And so there's no reason to walk alone, and don't be overwhelmed with it. So I'd encourage you to reach out to Tarina Rashika as a first point of departure. If you have any questions, I'm glad to explore with you how we can help. And so for that, I just want to thank everyone for joining the conversation. The recording will be recorded, like we said, and made available on our channels. And so stay well, stay safe until we connect again. Goodbye.